Welcome to our Moments with Investments Gurus webinar. Before we jump into the heart of the program, let's take care of a few housekeeping items. We applied for Continuous Professional Development or CPD points for this webinar. To ensure you receive these points, please make sure you watch the full session and add your ID number to the CPD section. You can watch this event on this platform at any time until the end of June 2024 and still be eligible for your CPD points. The CPD certificates will be mailed to you in July 2024. We encourage you to actively participate in the discussion. If you have any questions throughout the presentations, please feel free to ask by using the Q&A section, which you'll find to the right of your screen. Our speakers will be on hand to address your questions either live during the event or they'll get back to you after the event. You can find more information about our speakers under the Speaker tab located on the top menu bar, or if you scroll down. Additionally, if you'd like to download the presentations being shared today, look for the PDF download link. Our first speaker is none other than Theo Terreblanche, our Executive Head of Investment Management, who will do a brief introduction. Welcome, Theo, to the stage.
Thank you, Mike. Good day, everyone. Welcome to the next installment of our Moments with our Investment Gurus webinar, and the first one for 2024. Can you believe we're halfway through the year already? The macroeconomic factors shaping economies and asset returns around the world are well known to most of us. These include persistent high inflation and higher for longer interest rates across most countries, geopolitical tension in Eastern Europe and the Middle East, and slow economic growth in China post-COVID. Additionally, investors also have to navigate factors such as the high valuations on tech stocks in the US and volatile currencies in emerging markets. Although the impact of these factors are far from certain, arguably the biggest risk facing investors in the year ahead is political risk across the globe. No fewer than 64 countries, representing almost half of the global population, are going to the polls in 2024. The outcome of many of these elections hang in the balance, like the US election in November, while some are foregone conclusions, like the recent Russian election in March. Each, though, has the potential risk and opportunities for investors. South Africa's own election in May this year feels like a watershed moment for the country. Indications are that it will be the most closely contested election since the dawn of democracy, with coalition governments predicted to be the order of the day across provinces and even potentially at a national level. With this as background, our aim today is to unpack some of the potential outcomes and the impact this could have on investment portfolios. First up, Momentum investment economist Sanisha Pakrasamy will discuss a number of potential political scenarios and, importantly, the economic consequences of each. Vital information to keep in the back of your mind when listening to the rest of our speaker lineup today. Next up, our Chief Investment Officer, Mike Atsitz, hosts a panel of experts sharing views on how portfolios should be managed during periods of political uncertainty. Mike will be joined by Herman van Papendorp, Head of Investment Research and Asset Allocation, Keegan Dodo, one of our fixed income fund managers, and Pelo Manyaneng, Head of Listed Property at Momentum Investments. This discussion should provide you with some valuable considerations around how to approach your clients' portfolios over the coming months. After the panel discussion, Ian Scott, Head of Fixed Income, will share his views around fixed income in a time of heightened uncertainty regarding global central bank actions and the domestic election. Ian will be followed on stage by Lofty Botha, Head of Systematic Strategies at Momentum Investments. Lofty will discuss how different equity factors are expected to play out during periods of uncertainty by looking at experiences in the past. Following Lofty, Mike will be back on stage to summarize today's event and share his key takeaways. We hope you'll enjoy the next 90 or so minutes with us, and as always, please feel free to reach out to any of us afterwards should you want to discuss any of the topics from today or require more information. Thank you again for joining us, and enjoy the session.
Thanks for setting the scene, Theo. I will now hand over to our economist, Sanisha Pakrasamy, who will discuss the political scenarios and economic consequences of the upcoming elections. Thank you for joining us today, Sanisha. Please take it away.
Thank you, Mike. Hello, everyone, and thank you for joining us. The democratic stage is primed for a momentous year as an unprecedented supercycle of elections worldwide promises to reshape the political landscape in 2024. From established democracies grappling with rising populism and economic worries to fledgling democracies facing the test of legitimacy, voters in at least 64 countries will head to the polls this year. Among these are 8 of the most populous 10 countries in the world. This year's elections are set against a backdrop of rising authoritarianism. These are political systems that are characterized by limited civil liberties and centralized power. Although democracy is far from running out of steam, as was evident in Poland in October last year, surveys mark a retreat in democratic spirit. According to the Varieties of Democracy Institute, the quality of democracy enjoyed by an average global citizen in 2022 was back at the levels experienced in 1986. The perception of democracies being slow to respond to social demand has likely contributed to the splintering of the electorate away from centrist parties. In the post-World War global geopolitical structure, certain elections will hold significant importance. The headline election will be held in the United States in November this year, with a narrow result potentially inflaming existing tensions. Moreover, the European parliamentary elections in June could also deepen divisions, especially if radical right-wing parties gain more seats. While localized unrest is a key risk in this volatile geopolitical environment, there are wider-reaching consequences from these uncertain electoral outcomes for foreign policy, trade relations, and even global supply chains. South Africa stands as a microcosm of these global political trends. The upcoming general elections on 29 May hold the potential to profoundly reshape the nation's governance framework against a rising tide of global electoral uncertainty. Polls currently paint a precarious picture for the African National Congress, or the ANC, the nation's dominant party since the end of apartheid in 1994. The prospect of the ANC falling below 50% of the vote for the first time, as indicated by a number of opinion polling institutions, including the Brenthurst Foundation, the Social Research Foundation, and Ipsos, amongst others, is a stark reflection of growing public disillusionment. Deteriorating service delivery, crippling infrastructure woes, and a perceived lack of progress in tackling corruption have all eroded trust in the ruling party. Socioeconomic inequality and job scarcity, as well as an unequal opportunity to quality education, have created a view that democracy has not delivered a better life for all. In 2004, when the country celebrated a decade of freedom, 59% was satisfied with democracy. Now, only 22% are satisfied with how democracy is working in South Africa. The Human Sciences Research Council, or HSRC, notes that confidence in national government fell from 69% in 2004 to only 23% in 2022. Trust in Parliament dropped from 65% to a mere 21%, and trust in local government went from 48% to a paltry 25% in the same period. The HSRC notes that the biggest falls in confidence have unsurprisingly coincided with high-profile government scandals. In response to government's failures in adequately addressing the nation's economic and social ills, there has been a surge in the opposition party landscape, with over 350 parties registering for this year's South African elections. Now, many of these are led by former political figures who have defected from established parties aiming to capitalize on voter dissatisfaction. While this signifies a potentially vibrant democracy, it can also be interpreted as a symptom of deep-seated discontent with the existing political system, and this can lead to voter apathy. Global voter turnout has been in decline since the 1960s, partly owing to generational replacement, where older voters are more likely to view casting their ballot as a civic duty. Rising inequality also plays a significant role in discouraging citizens to vote. The level of voter engagement nevertheless meaningfully impacts the integrity of the democratic process. Research undertaken by the Journal of World Politics indicates that decreased voter turnout results in skewed socioeconomic representation, biased public policies, and reduced government accountability. It can even create conditions for increased patronage. Promisingly, the number of registered voters has increased appreciably in South Africa from 18.1 million in 1999 to a record 27.8 million registered voters for 2024. However, a significant portion may not participate in the vote. Out of the 26.8 million registered voters for the 2019 general elections, only 17.7 million votes were actually cast. This suggests that more than 9.1 million people did not turn out on the day to vote. This left voter turnout below 66%, largely driven by youth disenfranchisement, which we think can be attributed to unemployment, corruption, and poor service delivery. However, with this year's national and provincial elections more hotly contested than ever before, we could potentially see a revival in turnout levels with a higher number of youth registering to vote. The 18 to 39-year age band of registered voters accounts for more than 40% of the voters' roll this year. Moreover, the possibility of the ANC falling below 50% could rally the opposition base in the country's urban areas in particular. The potential shift in political power, as highlighted by recent polls, could usher in a multi-party governing landscape, possibly at a national level, which would be an historic first for South Africa. While progress towards democratic pluralism is a positive development, concerns linger. Coalitions have a checkered past at a local level, with many urban centres experiencing ineffective governance since 2016. After the 2021 elections, 70 municipalities experienced a hung council necessitating coalitions. Between 2021 and 2022, metropoles such as Nelson Mandela and Tshwane experienced a collapse in administration, which tarnished the nation's confidence in a multi-party democracy. While many coalitions at the metro level since 2016 have been notably unstable, there are nevertheless a number of well-functioning and stable coalitions established in municipalities throughout the country. The Government Performance Index, conducted by Good Governance Africa, factors in things like administration, governance, planning, management, and service delivery when ranking South Africa's municipalities. Standard Bank Group Securities, or SBG, highlights that out of the 20 top-performing municipalities of 2021, 4 were governed through coalition governments. A number of local government coalitions have experienced disintegration and a reconstitution in South Africa due to parties using them as a political battleground between elections. In comparison, constructively institutionalized versions of coalition governments have emerged where there's been a sense of shared national interest and policies. Global examples of successful coalition building include Austria, Germany, Japan, Malaysia, and Chile. The Centre for Social Change at the University of Johannesburg notes that coalitions can work more effectively in countries where there are first minimal ideological differences between parties, secondly where there hasn't been a dominant party in charge for a long time, and thirdly where opposition parties are not weak and fragmented. Programmatic alignment is thus crucial for coalition arrangements to be successful in South Africa. The national and provincial election outcomes are also likely to reflect new trends. A shift away from emotional loyalty to established parties has been evident in split voting trends. This is where voters strategically choose different parties for national, provincial, and local government ballots. This points to a more nuanced political landscape. The battle for urban areas will likely be fierce, with the ANC expected to retain dominance in rural areas. Gauteng and KwaZulu-Natal, however, stand out as potential battlegrounds where coalition governments at a provincial level seem likely. While uncertain at the time of filming, Should the courts rule in favor of former President Jacob Zuma's Umkhonto weSizwe or MK party to remain on the ballot, they will pose a formidable threat in KwaZulu-Natal, given the high concentration of the Zulu population in that province. With Gauteng and KwaZulu-Natal accounting for 44% of the country's population and 49% of the country's GDP, election outcomes here are viewed as pivotal. The ANC's stronghold in the traditionally rural bases, nonetheless, will likely carry it comfortably over the 50% mark in provinces like the Eastern Cape, Limpopo, Northwest, and even Mpumalanga to a lesser degree, given the entrance of the MK party on a crowded political stage. Moreover, by-election data points to trouble for the official opposition party, the Democratic Alliance, or DA, in the Western Cape, as support for the Patriotic Alliance, the National Coloured Congress, and the Good Party have increased. Moreover, the DA's initial steadfast support for Israel in the Gaza war may see some voters defect to the ANC. Recent polling results suggest sustained pressure on the ANC. The results are also flagging limited growth for the DA and the Economic Freedom Fighters, with parties outside of the top three potentially collectively securing more than double their share of the vote compared with 2019. According to SPG Securities, a number of potential key election outcomes are on the table at the time of filming. In the most probable scenario, which SPG attributes a 60% probability of materializing, SPG notes that the ANC would garner between 43% and 47% of the national vote, requiring them to partner with a mid-sized coalition partner such as the Inkatha Freedom Party. In our view, if this scenario were to play out, it is likely that the direction and the pace of structural reform would be broadly kept intact given the closely linked ideologies of the ANC and the likely coalition partners under this scenario. In the next scenario, SPG Securities sees the ANC securing 48% or more of the votes. This scenario holds a 1 in 5 chance of occurring, according to SPG's analysis. If the ANC manages to get over the 50% line, they would not require a coalition partner. However, if they drop below it, they would need the support of a smaller party. While this would imply lesser control for the minority party, it would still allow for a strong coalition to govern the country. SPG notes that each 1% of the vote equates to 4 seats in parliament, so a 48% win by the ANC would require the votes of only 8 MPs to secure a majority in parliament. As such, the direction and pace of structural reform would, in our view, continue on the current path. In the remaining scenario, which holds a 20% probability of transpiring, the ANC gets less than 42% of the vote. A plethora of election outcomes could evolve from here. The most market-friendly of these outcomes would likely be an ANC-DA coalition, under which we would likely experience a step-up in governance and accountability, a crackdown on corruption, increased investor sentiment towards South Africa's economic prospects, and a revival in fixed investment. This would ultimately lead to a higher growth path for the country, enabling a reduction in unemployment and poverty. In an alternate outcome, the ANC could partner with the multi-party charter. SPG notes that under this scenario, there would be support to protect the Constitution and critical institutions such as the Reserve Bank, the South African Revenue Service, the National Prosecuting Authority, and National Treasury. While authorities would encourage private sector investment in this scenario, we believe that structural reform efforts would lag given the number of political constituents involved and their difference in views. SPG also considers the option of the ANC partnering with the EFF or the MK party, or even both, in the scenario where the ANC drops below 42%. In our view, this would result in the most economic damage, given some of the more radical views expressed in the EFF and MK parties' manifestos. A shift to the left in policies could result in a souring of international relations with the West, capital flight as confidence in SA's future growth plummets, and a more divisive society. In this scenario, we would likely see a lower fiscal restraint being exercised, debt soaring to higher levels, and a further weakening in the currency leading to elevated inflation. Moreover, any abrupt or unconstitutional changes could undermine the country's democratic institutions and its legal framework in this scenario. These resultant deficient socioeconomic outcomes would likely lead to a loss in support for this form of government by the time of the next general elections held in 2029. In the last alternative, under the scenario in which votes for the ANC fall below 42%, a minority government is considered. On the upside, a minority government allows for a higher level of accountability, given that key economic decisions require broader scrutiny and support. Additionally, a more inclusive outcome can be reached given the diversity of views involved. Nonetheless, a minority government comes with its own set of challenges, such as political instability when struggling to pass key pieces of legislation, or policy compromises leading to a watering down of growth-enhancing priorities. Moreover, political deadlock can ensue, leading to a loss in confidence. Taking these probabilities of these scenarios into account, there is a strong chance that Cyril Ramaphosa will remain as president of the country. A survey from Afrobarometer shows that citizens polled are more satisfied with Ramaphosa than they are with government in general. Ramaphosa enjoys a firm level of support across the provinces, the leagues, the National Executive Council, and the ANC's alliance partners. However, if support falls significantly for the ANC in the upcoming elections, the probability of Ramaphosa securing a second term as head of state would indeed be lower. The uncertain political climate casts a long shadow on the economy and has acted as a major constraint for investment prospects in the country for the better part of a decade. An evolving political spectrum and economic projections underscore a nation in flux. The outcomes of these elections will not just determine governance, but also shape the economic discourse, depending on political players' willingness and ability to take the difficult decisions needed to enable a higher level of growth while preserving fiscal prudence. South Africa's future hinges on bridging socio-economic divides, navigating logistical hurdles, and harnessing the power of a politically engaged and empowered society. Your vote truly counts. I thank you for your time.
Thanks for sharing such great insights, Anisha. Next is a panel discussion moderated by our Chief Investment Officer, Mike Atsets. The panel will discuss managing portfolios under political uncertainty. Welcome, Mike, and the panel. We look forward to your insights.
Thank you, Michael, and welcome to our panel discussion about managing investment portfolios in times of uncertainty. With me today is Keegan, a bond portfolio manager at Momentum Investments, Herman van Papendorp, head of macro strategy and research insights, and Pello, our head of listed property. So in the current environment, there's a lot of political and economic uncertainty. Globally, inflation seems to be stickier than everybody expected, and interest rates are staying higher for longer. Going around the world, approximately half of the democracies by population are going through some sort of election. So there's a lot of political and geopolitical tension and uncertainty. And in the local environment, we also have elections tomorrow. So there's a lot of uncertainty and angst in terms of what's going to happen in the future and how do we navigate and manage portfolios in this environment. So starting from a macro perspective, my first question is going to be directed to Herman. Just from your view, a local and global macro perspective, how would you suggest managing portfolios in this environment of political and economic uncertainty?
Mike, philosophically, the only thing that we can really be certain about the future is obviously the fact that it is uncertain. I think as investment managers, we need to have the humility to really realize that the reality is that financial markets are largely unpredictable. But the silver lining in all of this is that uncertainty also provides you with investment opportunities. When market prices move significantly away from the range of probable outcomes that are likely. And that you can actually then exploit as a fund manager in this kind of environment. Now, this normally happens when you either have excessive pessimism in the market or you have excessive optimism. Remember that the father of value investing, Benjamin Graham, used to say that the intelligent investor is a realist that buys from the pessimists and he sells to the optimists. Now, if you look at financial markets, they are always uncertain, and a lot of the time they are very much volatile. But I think 2024 is quite an interesting one, because here we've got the added uncertainty of heightened political risk. And if we have the environment here where more than half of the world's population actually this year are going to be heading to the polls, this is the highest ever proportion of the global population that's actually going to have some sort of a vote one way or another, either in regional elections or in country elections. So this adds another angle to political risk this year, which is different from other years and maybe will increase for global financial markets the potential for election-induced volatility that we need to deal with this year.
So there's a lot of uncertainty, and as the saying goes, smooth waters do not make good sailors. So definitely we are not in a time of smooth waters. And a big facet of investment markets, apart from valuation and what's the right time to invest, is the duration of your investments and investor sentiment. So just in terms of the context of the current economic and political uncertainty, there's going to be a lot of sentiment driving investor behavior. Just your views in terms of what are the implications for investment markets and how should we go think about the opportunity set going forward?
Thank you, Mike. I think in thinking about the implications of political uncertainty on investor sentiment and market behavior, it's important to recognize that it's multifaceted. Firstly, there's obviously a recognition that we don't know what the potential outcome is going to be from these upcoming elections, which party is going to come on top. And also, in addition to that, what policies this party or these parties are actually going to adopt and the implications of those policies on the economy and in markets. So these are very difficult things to predict. But I guess also it is important to recognize that, when sentiment turns negative, there's confidence wanes. So people generally take a longer term time to actually make decisions. So if I bring it back to the real estate space, what typically happens is transactional activity comes to a slowdown. Leasing volumes also slow down as well. And again, bringing back to financial markets, the same also applies, that volatility increases as well as risk premiums also increase, which are all signs that markets are concerned about a potential thing that might happen in future that might have an impact on markets. Typically what happens during that period of time is that most investors will then choose to sit on the sidelines, either sell some of the securities that they hold in their portfolios to up their cash positions. And what that invariably does is that it creates selling pressure on markets. So I think what is important for us is to remember that leading up to the elections and potentially a week or two post-elections, there's going to be heightened volatility, as Herman initially mentioned. But for us, we think that presents an opportunity to identify and acquire good quality companies at discounted prices in this market. So that's actually what we will be looking out for in this market.
So you really need to look through the cycle and invest for the long term. And a lot of volatility gives you good investment opportunities. You touched on cash a little bit. So my next question I want to ask to Keegan, who should be managing the stable and steadfast asset class bonds, which clearly it has not been. There's been a lot of volatility in global bonds, interest rates being quite sticky, inflation being sticky. We've seen yield in South African bonds at high levels, so it should be a great investment opportunity, but with the political overhang and risk in the market, we've not seen the returns that we're expecting out of bonds. So just your view in terms of the current context and looking through the elections, is South African bonds and global bonds an investable asset class? Are we going to be rewarded for living through the current volatility?
Thank you, Mike. So bonds have been a challenging asset class to manage over the last couple of years, especially this year given all the political noise, geopolitical noise, and I think specifically in terms of the election that's coming up. But I do think in terms of the risk premium that's baked into the nominal bonds is specifically largely a result of South African specific risks. And we're at one of the worst times in terms of risks at the moment. The forward rate market has basically repriced the entire interest rate cutting cycle, and as a result, within the South African yield curve, interest rate cuts this year has been totally priced out of the market, which is, to us, it's a good thing, because if inflation decides to tick down or closer to towards the target bands, what we would see is in any event where any of these central banks, whether it's the Fed or the SARB, becomes a bit more dovish, we could see that yield curve reprice quite significantly, and it can unlock that risk premium that we've seen in nominal bonds. And I don't want to put percentages on it, but we could see bonds trade a lot lower. If you look at where bonds are at the moment, a 10-year bond is trading at about 12, 14 versus where CPI is. It's almost CPI plus 7. Bonds shouldn't trade, to me, bonds shouldn't be trading at these extreme valuations. And for us, we need to buy the point where the bonds offer the most value. Now, I can't say that it won't go to 13% if there's anything fundamental that happens, but what I can say is, as a valuations team, we need to buy bonds at this point in time. But unfortunately for foreigners, they have been selling off our bonds as a result of all the negative political and geopolitical risks across the globe and emerging markets. But I do think that any small dovish movement within any of the central banks, we could see yields trade a lot lower.
So currently cash is king, and bonds are clearly the prince in waiting.
Yeah,
So their time will come. We just need to get through the current environment.
Exactly.
I mean, a big factor influencing the pricing of listed property is currently where bond yields are. And it seems that bond yield pricing are very reflective of the uncertainty and political uncertainty we've seen in the local market. So just Pello, your view in terms of the listed property, the impact of the current yields on the valuation of listed property, and what is the opportunity set for listed property looking through the cycle?
Yeah, thanks for the question again, Mike. So I think our view is actually quite different from the views presented by Keegan, because if I think about the rally that we've seen in listed properties since the fourth quarter of 2023, all the way through to Q1 of 2024, we've seen a massive rally in the asset class, to a point where we felt that actually the sector is priced at a premium, and we needed to see a little bit of correction coming through. We have seen subsequently a bit of a sell-off, but we haven't observed any election risk premium attached to listed property, the same as Keegan sort of mentioned on the bond side of the equation. But given where bonds are trading at 12% and earnings yield on property at around 10.5%, we think that there is definitely a likelihood that you'll potentially see property in its correction also adjusting closer to where bonds are actually trading at currently.
Okay, so Harman, you've listened to the inputs from Pello and Keegan that just talked about some of the detail of their specific asset classes, but you have the opportunity to have a more macro view, and looking at the inputs and looking at the current context and going forward, how would you suggest or how would you think about managing a multi-asset portfolio in the current environment?
Mike, I want to sort of at the outset sort of just take a bit of a step back and almost say that, you know, what we need to realize that at Momentum Investments, we really remain steadfast in our approach of taking a very long-term investment horizon. And we try not to have knee-jerk reactions to short-term events like politics and so forth.
Timing the market.
Yeah, exactly. And so that's the first kind of factor that we always take into account. I think also we try and to remain focused on our primary strategic investment objectives, our goals down the path, despite these transient political noises that we'll sort of see from time to time. So I think, you know, we like to remain focused on, you know, fundamentals of companies, on long-term fundamentals, on valuations, And that is really the driving force for our views on specific asset classes, rather than sort of having these kind of short-term political noise reactions to what is sort of the events of the day. Nevertheless, if we do look at how we deal with political noise in our portfolios and other uncertainties, I think we fortunately have a number of tools available to us to actually manage our portfolios across asset classes, really. I think the first thing that we do at Momentum Investments is we do a full-scale scenario analysis over a longer-term time scale, because we don't want to have just one specific view that we align ourselves to, because that specific view could very much be wrong. So we do like to assess a number of potential developments that could play out over the next number of years in our portfolios, and then try and gauge, what could be the market reactions if one of these scenarios does play out in our portfolios, because that gives us the opportunity then to change our portfolios at the time. So we won't be totally surprised if scenario 1 plays out relative to scenario 2, because we do know that how the markets will react, and that gives us that almost dynamism that we can actually adjust our portfolios in this kind of framework.
And just quickly, in the scenario work, and we'll come back to that a little bit later, even if there is multiple scenarios, what you identify through the scenario work is potential flags to look out for, and once you start seeing those flags and getting an indication of which scenario might actually actualize over time, you can make the necessary adjustments, but important that it's not knee-jerk reactions.
Yeah.
It's got to be careful, considered, and long-term views that we ultimately bake into the portfolio. Tactical around the edges is a little bit different, where you want to be a bit more opportunistic and take the opportunities that come. But yeah, scenarios is definitely a tool for broadening the mindset and thinking about what are the potential outcomes, and prepare yourself how to manage portfolios as you start seeing one scenario might be the winner versus the others.
No, correctly. And this also changes over time. We see it when we do our annual scenario exercise, which we call a sort of a medium-term scenario exercise, where we look at kind of paths over the next 5 years for economic variables, paths for asset class returns. And we see that these things do change over time.
Yeah.
We actually attach higher probabilities to certain scenarios as time goes on, because we see, a certain scenario suddenly becomes a higher probability event than another scenario, which might have been different a year or two ago when we did the same kind of exercise. And sort of we just finished recently our medium-term scenario exercise, and quite interesting results coming from that. We've sort of built 3 main scenarios, and we look at the kind of paths of these economic variables and asset class returns in that. So scenario analysis is definitely one of the aspects that we can look at. Diversification is another one. I think, if we look at diversification, that's the one free lunch that we do have in investments. And I think, again, when we look at diversification of your portfolios, it means not only across asset classes, but also across regions. So, again, if you look at the cross asset classes, what we want to have is significant exposure to different asset classes that behave differently in certain scenarios, because that gives you that downside risk protection almost when you have those kind of asset classes in your portfolio. And across regions, we have obviously South African exposure relative to offshore exposure. And these 2 main asset classes, SA versus offshore, they behave very differently in different scenarios, depending on what the currency does and whether there's a risk on or a risk off environment globally and locally. But not only that, if you look at the asset classes as well, some of these asset classes are negatively correlated. Often it's the case that bonds and equities are negatively correlated. They're not always. Let me just make that clear. But a lot of the time they are negatively correlated. So you want to have bonds and equities, global and local, in your portfolio to sort of have that diversification. But also some asset classes are totally uncorrelated. Gold is a great example of that. That's uncorrelated with other asset classes. So you want to have some exposure to gold, so that if more positive scenarios don't play out, that you actually at least have that as your natural hedge in your portfolios, to have gold in there. So diversification, very important. I think another thing what we can obviously always consider is having hedging in our portfolios. It's important to actually have that ability to hedge some part of your risk profile against political risk, for instance, to have a hedging in there so that can protect your downside, but it also doesn't remove the potential upside if there's actually a positive outcome coming through from a political event or whatever. And I think, another sort of tool we have with us is dynamic asset allocation. We used to call it tactical asset allocation, but I like to have the word dynamic in there because it does show you that we can sort of react to what happens in the market. So again, we'd like to monitor news flow in the markets. We like to monitor political developments in the markets to see, do we need to make some changes, shorter term tactical, as you mentioned earlier, in our portfolios relative to our strategic long-term kind of profile of our asset class exposures. And that gives you that opportunity to actually do that if you have dynamic asset allocation. And I think the final thing that I want to mention is that, we always want to have some liquidity in our portfolio available so that you do have either cash or other liquid assets available so that you can then make use of opportunities that do come forward as uncertainties play out in the market. So I think when we use all these kind of tools and we take a very much a proactive or an adaptive kind of approach into our investment decision-making process, then I think you have this ability to maybe protect the downside, but actually have that opportunity to participate in the upside as well when more positive scenarios play out.
And ultimately, we don't have a crystal ball. So, the uncertainty, the risk and opportunity, we've got to be very circumspect and be humble enough to know that we're not going to make the right calls necessarily all the time. So diversification and some of the other strategies are critical. And even within particular asset classes, you could have a broad range of diversification within the sub-asset classes. So if I'm thinking about the health of the South African government and its finances versus the health of South African corporates. It's a really chalk and cheese, and very often you have a conversation that when you do a rating on a corporate, if it wasn't for the sovereign ceiling that a company can't be rated better than the country, we'd have a lot of corporates that are better rated than the South African government because they've got healthy balance sheets and they're not necessarily that linked to the South African economy. So my next question is for Keegan, just talking a little bit about the disconnect that we're seeing between the credit markets or the credit components of the fixed income market and the sovereign parts of the fixed income market. What are your views around the opportunities that are presenting themselves to invest in specifically credit at the moment?
Thank you, Mike. I think it's very important. Herman has mentioned the diversification part. So diversification as in fixed income space, specifically for credit. Credit tends to react a lot differently to the traditional government bonds. And it's a similar situation on a global basis. So if we look at credit as an example, on a global scale, there's been about $6 trillion that has been chasing credit opportunities. And as a result of that, we've seen the credit spreads on a global basis narrow quite significantly. And the reason for that is a lot of the market is concerned around the government's monetary policy, communication around monetary policy on a global basis, and they're chasing yields from a corporate perspective because you can get quite a good yield pickup on those corporate names from a global perspective.
So investors really want discipline in their investments, and what we've seen with a lot of governments is they're anything but disciplined with the printing presses and the auctions, whereas corporates tend to have a little bit more discipline, and it's that attractive opportunity set that investors are trying to access.
Exactly. And so if you think also about the South African market as an example, so we have the same problem in South Africa where we have a pool of money that is chasing so few credits. And as a result, the supply and demand dynamics within the South African corporate market has been so, it's offset because, and then spreads are so tight because of that search for yield. So we sit in a position where corporates have good balance sheets, they're unlevered. Some of the companies, if you look at like the likes of your Shoprites and the likes of your Pick n Pays, they're not coming to the market to raise debt because they have sufficient cash on their balance sheet, so they don't need to raise debt. But that doesn't help us in our adventure for trying to find credit. So I think credit is exceptionally important in our portfolios, but just the demand and supply dynamics has made it very difficult, and those spreads globally and locally has come a lot tighter just because of that demand.
And notwithstanding that, there's a healthy chunk of credit in your bond and generally in our fixed interest portfolios. And just coming back to you, Pella, you know, we've talked a lot about risk management and the opportunity sets, and, you know, a volatile time might be the right time, you know, to purchase an asset and hold it for the future. So just in terms of your asset class, the listed property sector, what do you think about the risks and the opportunity set? So how should we approach it as part of a broader, diversified portfolio?
I think what we're doing in the portfolios now, given the uncertainty that exists in the market, is that we've increased our allocation to high quality companies that are paying dividends. Because you tend to find that during periods of volatility, these companies, the dividends that they're actually paying out, act as a buffer against capital losses when there's volatility in the market. So that's what we're doing. We're buying high quality, high yielding property companies in the portfolio. But to Herman's point also, in addition to that, we're also looking at it from a diversification perspective, that in periods where there's this uncertainty that's playing out, there's the rand typically also sells off. So what we're doing is we've also allocated a portion of the funds into these offshore companies that operate in regions such as Western Europe and Eastern Europe, with the view that if our currency depreciates, there's a benefit of that we're getting in the portfolio as well.
I mean, ultimately, we're not going back to the Stone Ages. So people need places to live, they need places to work, they need places to manufacture. So, I mean, property is going to be around and there will be investment opportunities. And you need to think about it in the context, even with some of the headwinds we currently see, well, not recently, but in the longer term, that it is an investable place to be. And it does have an important role in a diversified portfolio. But Arman, you might have mentioned scenarios a little bit earlier. So I just wanted to ask you quickly, can you just run us through some of your most recent scenario work? And, you know, it might not be one crystal ball, it's 3 little crystal balls. Just run us through your thinking there and what we should be on the lookout for.
Sure, Mike. I mean, we've run 3 scenarios. We have identified 3 scenarios at the moment. I mean, in our base case, which we call muddle through, we see there that global growth is slightly lower than pre-pandemic levels, but inflation interest rates somewhat higher. On the local domestic front, we see the ANC probably having to go into a coalition government with a number of smaller minority parties.
But still being able to arm wrestle them.
Yeah, but and still continuing this kind of status quo of market reform that we have at the moment.
Getting better slowly.
Yeah, unfortunately not a great environment in that kind of base case, but it's still a bit of a risk-on environment globally, so your kind of risky assets still do somewhat better. So, you know, the assets that we would favour in our base case would be South African and emerging market equities, also South African nominal bonds and South African ILBs in Keegan's area. But we would avoid things like, you know, global cash and global nominal bonds. In our best case kind of environment, where which we call reflation, that's an environment where it's totally risk on globally, where your global growth, global interest rates, global inflation, they're all normalized to pre-global financial crisis levels. So it's very much a strong risk on environment. You want to favor the risky assets around the world, including South African assets as well. So there you want to favor, you know, very much an environment where you want to have still South African and emerging market equities, South African nominal bonds, but then Pello's listed property starts coming up as a good asset class to own in that risk-on environment. But there you would want to, again, stay away from nominal global bonds and global cash. In our downside risk scenario, very negative kind of outlook, there you really have deflation in an environment where, you know, your growth globally, inflation and interest rates, they all plunge towards zero, even below zero. That's very much a strong risk-off kind of environment. In that kind of environment, we also have domestically that the ANC loses a lot of there's support so much so that they've actually got to go into a coalition with probably a larger leftist kind of populist party. So you could see more populist policies come through in that kind of framework. And in that kind of environment, with this risk-off scenario, very much gold comes to the fore as an asset class that you would want to favor. Probably in that environment, global bonds as your sort of risk-off kind of asset will come through as a positive. And what you would want to stay away from there is global listed property and then local listed property as well in that risk-off kind of scenario, and also developed market equities because of the valuations that are really not in their favor and they don't do well in a global risk-off environment.
I mean, there are definitely risk and opportunities, and hopefully we do get a stable center with coalitions around the margins. I think at a national level, that will be the story. It's going to be much more interesting if we look at a provincial level, but tomorrow and the next couple of weeks will really give us insight in terms of how that plays out. But definitely a long-term investments is a long-term gain, and you need to think through the shorter term. Before I close the panel, if I can ask my panelists for some last thoughts, if they have any. So I'll just go around. If I can start with you, Keegan, any last thoughts for our investors and clients and advisors out there?
Okay, thanks, Mike. So I think just from my point of view, nominal bonds, inflation-linked bonds in the short end do offer value. We're trying our best to ensure that we get some credit as well in the portfolios to create a diversification. And I think that, to Herman's point, if Herman's base case comes to the fore after the elections, I think nominal bonds can easily unlock that domestic risk premium.
And yields come down, and capital comes back.
Exactly.
Your side, Herman?
I think added to that very much local equity as well, because they've also got a big risk premium in there. And maybe then a final point from me, Mike, the other diversification angle which we didn't discuss today is obviously the fact that we have private assets as well, your alternative assets like hedge funds, private equity, infrastructure. Those are things that also feature in our portfolios throughout to really also hedge our bets against the potential outcome that we will have politically.
And yourself, Pella?
Yeah, thanks, Mike. So we focus on fundamentals, and I think in this period where there's uncertainty, that's what investors should actually be looking out for. Focus on fundamentals. Yes, there is political uncertainty, but in our view, this is potentially something that will pass. And post that, markets will come down, volatility will come down, and there will be opportunities in the market for you to acquire good assets at discounted prices.
So thank you, panelists. And in closing from our side, clearly we're in a short-term uncertain environment, but investment is a long-term game. And when there's uncertainty and volatility, if you look through the emotion, know that in time things will be okay, and there are going to be good investment opportunities. So diversification is key, valuation is key, and in staying invested for the long term is key. Thank you for joining us in the panel. I really enjoyed the conversation, and thank you to my panelists for participating.
Thank you everyone on the panel. Next up is Ian Scott, our head of fixed income, who will provide an overview of the current drivers and views in the fixed income market. Welcome, Ian.
Thank you, Michael. In this time of uncertainty, let's have a look at fixed income markets, how they're behaving, and what is fixed income markets actually telling us about this period of uncertainty. Now remember, there's actually two big drivers of uncertainty in the world at the moment. One is obviously inflation. The second is obviously the behavior of central banks reacting to this high inflation. And then domestically, we've got our own political situations and machinations as South Africa, and it forces certain behaviors from the fixed income markets. Cool, but let's start with the globe. So from 2021, we were in a rate hiking cycle. 2024 is going to be the year where the cycle turns. So what do I mean? So we've had rates up, now rates are going to be cut. The markets are obviously asking two questions. One is when rates are going to be cut. Two, by how much and by whom. So if we look at the pricing in the global forward markets, saying what is being priced in terms of the rate cycle, the markets are saying, right, we think the Fed, the Bank of England, the European Central Bank are all going to cut rates. The one outlier is going to be the Bank of Japan. Remember, they didn't hike through the hiking cycle because of low inflation in Japan. So they are on a hiking cycle. We've actually seen that first hike, and the market is expecting the Bank of Japan to hike even more. But we are waiting for the three major central banks to actually turn on policies, saying, look, we think inflation is getting to control. We can cut rates. We'll expect the Fed to be the leader. We're not so sure anymore. We think that European growth is slowing, the UK growth is slowing. Those two central banks may actually lead the Fed in cutting rates. The market is waiting with anticipation. Let's see what happens. The main issue is obviously inflation. Inflation very sticky for different reasons. So I said to you, the UK economy, the European economy is slowing. The outlier is obviously the US. The US is still growing, still good jobs growth, right? But inflation is sticky. Why is inflation sticky? A few things. Food. Food is still a problem. Insurance, rentals. Now those are the factors that interest rates can't just attack. So the central banks are saying, look, these factors have to get down before we can actually cut rates. And it may take longer than what we anticipated, and that, for example, the Fed may only cut in the latter part of 2024. Although we think that the ECB and the BOE will be forced to probably cut rates in the middle of 2024. Why? Because rates are elevated. If we listen to most of the central bankers commentate, they will say, look, interest rates are in a restrictive period or in a restrictive time. We can actually afford to cut rates when inflation slows. Right, so inflation is the sticky point at this point. The second part is going to be what is happening with global yield curves. Now remember, in developed markets, a lot of your yield curves are inverted, which is an abnormal situation. Remember, there's a thing called the time structure of rates, meaning longer rates should be higher than shorter rates to compensate you for the uncertainty of the future. But in G3, so your G3 yield curves are inverted, meaning the long end is below the short end. Short rates are the highest. Can you believe it? The 2-year point is actually the highest. That's an abnormal situation. It cannot last. It's not good for economic growth. So as economic growth slows and inflation falls, the market will then price that the central banks will cut rates, so those front end rates will fall, the curve will normalize and the long end will go up, which we call a normalized yield curve, which is then good for economic growth. So we're waiting for that, and that yield curve movement is actually good for emerging markets. But we'll get into that when we get to South Africa. Right. Remember in previous sessions that we had, you would probably have seen and heard me speak about credit spreads and that the price of credit is very expensive, although the quality is high. And it was very a South African phenomenon. Well, what we've noticed now, it's also a US phenomenon. Believe it or not, that credit spreads, high yield and investment grade spreads, are actually trading at very low levels. Now remember, levels that's low, spreads that's low, means prices are high. That's actually quite an interesting situation when you think that interest rates are high, the yield curve is inverted, and credit spreads are low. A very abnormal situation. But wait for us. The next slide will tell us why. It's about liquidity. There's still a fierce amount of money sitting in the US right in the front end of the curve, believe it or not. And there's all these names for it, repos and commercial paper and all sorts of different terminology. But what we're saying is that in that front end, in that cash pool of the US, there's about $6 trillion of unallocated cash, if you want to call it. It's just sitting and waiting there as a parking bay. What's it waiting for? Well, it's waiting for that rate cut cycle. It's waiting for the Fed and the ECB and the BOE to move. Why? Because once you cut rates, your more risky asset classes like property, like equities or infrastructure, long-dated assets, right? The prices are low, they're going to go up. This $6 trillion is waiting for that rate cutting cycle, which will also benefit emerging markets. So remember, and we'll get into it about foreigners selling emerging market assets, and we'll get into the South African situation. We believe that once the rate cycle actually commences and rates are being cut by the Fed, that some of that $6 trillion will find its way into emerging markets and South Africa will be a beneficiary. So we're all waiting for the Fed. And once again, you've heard me, it's all about the Fed. Once again, it's all about the Fed cutting rates and giving us that impetus as markets to move into more risky assets. Right. So that's the globe. So we're sitting on this cusp now saying, well, we're waiting for the rate cutting cycle. But what is priced into South African assets at the moment? So let's move to the cash market. Cash still looks attractive, and you've heard me say it before that cash is king. Why? Well, let's do this simple math. Inflation this year in South Africa is probably going to be around 5.5%, and in 2025 probably around 4.5%. But because the repo rate is up at 8.25%, bank spreads are above that, so we find that the 1-year NCD at the moment is probably trading in excess of 9%, and your 5-year rates are probably trading around 9.5%. Now you can clearly hear that when inflation is at 5.5%, and 1-year NCDs are sitting at 9 and just over 9%, when you get nearly 4% real, cash is very attractive. We are having a situation where cash is basically in equity space. I mean, if most equity managers can say to you that we can deliver CPI plus 4 or 5 over a long period of time, we've done well. Now we're telling you cash is giving you just over 4%. So if you're uncertain about the future, we don't know where South Africa is going, or you're uncertain about where markets are going, sitting in cash is not the worst place to be. The market is basically saying to you, we're paying you a higher rate to wait, and that's why you would probably find that in our portfolios we do sit with a fair amount of cash. We're also waiting for an opportunity to allocate capital to duration. What is the market pricing? So I think when we started 2024, markets were very bulled up saying, look, this year inflation is going to fall aggressively and all the central banks are actually going to cut rates by Q1, Q2, all the central banks are going to cut rates. Well, now we're closer to the middle of 2024 and we haven't seen too many rate cuts from these banks yet. Unfortunately, in South Africa, due to our own idiosyncratic behaviors, it now feels that the rate cut cycle has been postponed. If we just look at the market is basically telling us there's going to be no interest rate cuts for the next year in South Africa, which is just probably an overpricing from the market. We don't necessarily agree as Momentum Investments. We think that the SARB is cautious, and they're probably cautious about the political movements that's going to happen in South Africa over the next while, which is uncertain. And then once they've seen the waters calm, we probably can expect the SARB to get into the cutting mode as well. Why? Because the South African economy is not in a great shape. We know the consumer is not in a great shape. So we think that there's at least still one cut in South Africa in 2024, and there could be a few rate cuts in the beginning of 2025. So a protracted rate cutting cycle waiting for consumers. If we move to the credit market, so we still think that the credit market is a great place to be if you want to diversify away from government South Africa. We see corporate balance sheets every day. We see the results. I mean, corporates are still printing very good numbers in terms of the results. But for us as debt investors, we think that the balance sheets of corporate South Africa are just very stable, low probabilities of defaults. And we're also seeing corporates coming more and more back into the DCM market, or the listed rated market, if you want to call it, coming to issue papers saying, look, we think that interest rates, yes, the levels might be high, but the pricing is quite attractive. We want to issue some term debt into South Africa. And yes, we think that in this year, there could be like 130 billion of issuance into the listed rated market. And we've probably seen around 33, 35 billion of issuance so far in this year. So very aggressive issuance by corporates and by banks so far in 2024. And this is why. It's because of the spreads or the pricing. Now, remember earlier when you saw the slide around the US with that strong movement from top left to bottom right? Very similar situation for South Africa. Why? Because there's a big pool of capital that's looking for diversified risk away from, let's say, purely government bonds into corporate South Africa, because corporate South Africa, the balance sheets look great. So there's a bit of a supply-demand mismatch in this market. A lot more investors looking for assets in this market, which means spreads fall, prices go up. But you still think it's a good place to go and wait. So once again, I reiterate saying cash, credit, very good places to wait over the short term until we've got a clear view of where the rate cycle will go. Right, let's move into bonds. Let me start up and say bonds still remains our favorite asset class in fixed income, but it does come with a health warning. Yes, bonds have had a very torrid time in Q1 and the beginning of Q2 in South Africa and globally. Why? Because of this protracted rate cut cycle. As soon as the Fed stood up and said, look, we're not going to cut rates as soon as what you think, the whole bond yield curve repriced. We saw US bonds higher, South African bond yields followed. At one stage, our 10-year bond was trading as high as 12.5%. Now just listen to that again. Inflation at 5.5%, the 10-year bond yield at 12.5%. It's not often in your career that you would find a government bond yield at 7% real. So yes, we like government bonds, but we think it's an asset class for the future over the medium to longer term and not over the short term. Looking at the bond yield curve, still very elevated. And remember I said to you in the beginning, the G3 yield curves, so the US, Europe, those yield curves were inverted. Now look at South Africa. The front end is sitting right here around 8-9% and the long end at that 12-12.5%. Very steep yield curve, right? It means there's a lot of risk premium being priced to the long end. A lot of unknowns, a lot of Eskom risk, inflation risk, political uncertainty risk. Market says to you, we've got a lot of uncertainty, so we will pay you if you're willing to take that risk. And that's why we think there is opportunity in this market, but for the longer term investor. Why? Because this is it, is that, remember we talked around foreigners being out of the South African market, out of emerging markets? And these are the National Treasury data saying to us, foreigners have been sellers of South African and emerging market bonds. And the buyers of bonds have been banks, local insurers like ourselves, asset managers, collective investment scheme funds, and hedge funds. So the domestic market has been absorbing the selling of the foreign market. Now remember the 6 trillion graph I showed you? So hopefully when that 6 trillion gets released, some of that will come back into the market and foreigners will become buyers of South African bonds again. And that could be a big unwind of the yield and risk premium. And I will show it to you in the valuation as well. But first let's get to the CDS, because we're on this topic of foreigners out of our market, not really in emerging markets, and they're sitting in that front end of the US curve. And we can clearly see it in what we call a credit default spread. Now, credit default spread is basically the premium that you pay foreigners to invest in your bonds. Now, you can clearly see, if you look at the graph, somewhere between 2021, 2022, ourselves, even Turkey, Brazil, Mexico, the credit default spreads were very similar, meaning that foreigners were very happy to pay or receive the premium for all these markets. And then since, let's say, mid-2023 and now into 2024, we can see that the CDS spread, remember it's like a credit spread, when it falls, the price goes up. For all these other emerging markets have lowered, meaning that the market is willing to accept a lower risk premium for a Mexico and a Brazil, and even Turkey, but South Africa remained high. And we say, well, why is that? And this is this idiosyncratic factor that we have at the moment with unknown politics. We don't know what will happen with the election. We don't know what will happen with coalitions at this point in time. And the market says, well, because you've got this uncertainty, you've got to pay a higher premium. So at the moment, there is this dislocation between South African assets and other emerging assets. Once the political waters calm, we think that premium will unwind, and we think a lot of investors could come back into South Africa. Because why? Because I said to you that there's very few places in the world that you can get 7% real yields from government bonds at a 10-year point. So we think there's a great opportunity over the medium term in SA bonds. And if we look at the valuation, and you don't have to worry about all the numbers, it's just the number at the bottom says to us that at the moment, fair value around a 10-year bond is around 12%, where it is trading currently. But you can clearly see that the risk premium in inflation sits around 6.5, 6.49, saying the market is expecting too higher inflation in South Africa. And you can clearly see that if the inflation targeting regime does its work, which we believe it does, and inflation falls to around 4.5% over the next year, you take another 1.5% away from the 6.5%, you can clearly see that we can get to 11%, 1080 on South African bonds. And that in that environment, it's very possible to get double-digit returns from an asset class like this. This is what excites us about SA bonds, but the warning is out there that unfortunately SA bonds will also be that lightning rod. Just like the rand, when it's risk off, risk on, it will have these wild swings, and it does create a bit of a white knuckle ride. So if you don't want the white knuckle ride, what do? We think the other good opportunity will actually be in South Africa, inflation-linked bonds. Why? Because you get one, the protection if inflation should shoot out or stay high. And secondly, you don't have this white knuckle ride of the nominal bond market because they're trading much more stable. So I said to you at one stage earlier this year, nominal bonds went all the way to 12.5% when US bonds went nearly closer to 5%. But you can see it was a very stable trajectory for inflation-linked bonds. Now remember, ILBs in South Africa trade around 5% real. Earlier I said to you, when equity managers say to you, when they can get you 3 to 5% real, you've actually done a good job. Here we're saying to you, inflation-linked bonds with a stable ride will give you CPI plus 5, fairly guaranteed, right? We think this is an asset class for investors looking for high real returns without the white knuckle ride. So yes, we like inflation bonds. We think they have a place in our portfolios. Right, so to sum up, where are we at the moment? Well, let's start with the good news. Smile on the dial. Inflation is falling. Yes, it's taking longer than we all suspected, but it is falling. The Fed will cut rates. The ECB, the BOE, they will cut rates. The SARB will follow. It will cut rates. We are in that point of the cycle. And then, as I said to you, as developed market curves normalize, that benefits emerging markets. Why? Because suddenly that 6 trillion in the front of the US curve does not earn high interest anymore. It's looking for alternatives. Where's that alternative? Well, South Africa is that one alternative. We don't believe that South African state-owned enterprises are still in a great space. They need more bailouts, and that's not a great thesis for bonds at this point in time. But if we look at it overall, we think there's very good opportunities in the South African fixed income market for conservative investors to wait in the front end, in the cash market, in the credit market, but also allocate a little bit of capital to the longer end. We still think that over the medium term and longer term, there will be good returns for investors that's willing to be patient, seeing that central banks are patient, right? They're not in a hurry to cut rates. So I think we are going to be rewarded by waiting a little bit. So overall, it's still a good thesis for investments and fixed income out there. We just have to wait a little bit more. So, all in a nutshell, still a very good story to tell. Thank you for listening.
Thank you, Ian. Next, Lofty Bota, one of our smart beta fund managers, will explain how factors behave during period of uncertainty. The stage is yours, Lofty.
Thank you, Mike. Good day, everyone. One of the main reasons for the growing popularity of factor investing is its ability to deliver benchmark-beating returns. However, to give outperformance, one needs to take risk. And taking risk means that there will be periods of underperformance along the investment journey. With a lot hanging on the outcome of the upcoming local elections, we decided to discuss how South African-style factors typically behave during periods of uncertainty. Investors in the momentum trending equity fund believe the trend is your friend and cut your losses and let your profits run. It is well known that shares that did well in the past usually continue to do well. This can be explained by the concepts of anchoring and herd behavior. Anchoring happens when investors get anchored to historic perceptions. They tend to react slowly to new information and share prices initially underreact. As things become clearer, they react more and more in line with new information. This causes a trend. And due to herd behavior, leading market participants start and followers extend these trends that this fund aims to exploit. There are times, however, when trending strategies struggle to perform. Extreme uncertainties often cause market turbulence and trends may temporarily disappear. However, things always normalize. Unknown unknowns become known unknowns, and new trends form that can be exploited. The Momentum Trending Equity Fund delivered stellar performance since its launch, as it outperformed its benchmark by 34% until the end of March 2024. This was achieved despite the long period of elevated market turbulence since the onset of the COVID crisis early in 2020. The Momentum Value Equity Fund buys stocks that trade at bargain prices. Opportunities arise when shares overreact on bad news and when themes or sectors fall out of favor. Warren Buffett describes the value philosophy well. Price is what you pay and value is what you get. We aim to buy low and sell high by considering several valuation metrics. While value investing may require patience, investors usually get rewarded handsomely in the long run, as share prices eventually tend to gravitate towards fair value. Value strategies sometimes struggle in a risk-off environment. During periods of excessive fear, cheap stocks may become cheaper. The flip side is that from these lower levels, they often offer more upside potential. Despite cyclicality and the recent lag in performance, the Momentum Value Equity Fund delivered sterling returns since its launch and outperformed its benchmark by 25% until the end of March 2024. The Momentum Quality Equity Fund invests in well-managed companies. Henry Ford used to say that quality means doing the right thing when no one is looking. We believe that if quality is ingrained in a company's DNA, it would show up in key metrics for profitability and stability. And if a company scores well on these measures, it should be able to generate superior earnings growth, which in turn would lead to superior share price performance. While well-managed companies do outperform in the long run, the reality is that from time to time there will be periods when short-term fears dominate and when quality companies get overlooked. But we all know tough companies last and tough times don't. Being launched in August 2021, the Quality Fund is still relatively young. This is why we use a combination of actual and backtested data to simulate performance from April 2017 when its smart beta peers were launched. Our analysis shows that this strategy would have delivered quite acceptable performance, being 4% ahead of its benchmark by March 2024. Let us now turn our focus to periods of uncertainty in the local equity market by looking at the behavior of the top 40 volatility index. Since the start of our analysis, there were 3 local political events that are worth mentioning. The resignations of President Mbeki in September 2008 and of President Zuma in February 2018, and the recall without explanation of Finance Minister Nhlanhla Nene in December 2015 during President Zuma's reign. President Mbeki's resignation happened during the global financial crisis. As the volatility index was overwhelmingly driven by global events during this period, the impact of local political events was minimal. Managing money through the global financial crisis was tough. We now know that it lasted roughly from 2007 to 2008. However, within the eye of the storm, one never knew if the latest shock would be followed by an even bigger shock, or if the stepping in of the central banks would save the world. And long after the crisis was over, many punch-drunk investors missed out on an attractive recovery as they feared for a double-dip recession that never happened. While it is often said that the political landscape during President Zuma's reign was not that market-friendly, the volatility index was relatively calm during his presidency. Notable exceptions were when volatility spiked during the European debt crisis, and when it also went up during the period from 2015 to 2016, when the Finman crisis, the Brexit referendum and Donald Trump's election took place. President Ramaphosa was appointed early in 2018. Many investors hoped for a more market-friendly environment, but early in 2020, the COVID crisis drove volatility to its highest level since the global financial crisis. At the onset of the COVID crisis, investors remembered multiple previous epidemics that were non-events. And once in the crisis, no one knew how severe it would turn out to be or when it would end. Volatility did subside towards the end of the COVID crisis, but then the Ukraine crisis broke out, and ongoing challenges at Eskom and Transnet, together with the conflict in the Middle East, are keeping volatility in a higher than normal band. This chart shows the rolling 12-month performance of our trending strategy relative to each benchmark. We use backtested figures up to April 2017 when our product was launched and actual figures thereafter. Please note that backtested figures should always carry a health warning. However, we did not do our analysis to show how well these strategies would have performed. We did it to get an understanding of cyclical behavior and downside risk that are inherent in our processes. While average performance was attractive, there were also periods of material underperformance, sometimes even around 10%. While the 2008 lag was most probably caused by the global financial crisis and the 2021 lag by COVID, volatility was quite normal during the 2017 period when the strategy also was out of fashion. But what was particularly noteworthy is the stellar performance during 2011 and 2012 at the height of the European debt crisis. This was a period of materially elevated stress, which needed Mario Draghi of the ECB's "whatever it takes to save the euro" speech to calm nerves. A key observation is that periods of underperformance were typically followed by periods of strong outperformance. Nobody will ring a bell to announce when a crisis is over, and there is a risk of losing out big if one remains scared for too long. For the value strategy, we again use backtested figures up to April 2017 when our product was launched and actual figures thereafter. While average performance is attractive, periods of material underperformance occurred during the global financial crisis, during the three stressors of the 2015 and 2016 period, and when COVID broke out. Interestingly, the value strategy would also have fared well during the European debt crisis. It lagged right after the outbreak of COVID early in 2020, but then underwent a period of sterling performance from Feb 2021 to Jan 2023, despite COVID and Ukraine-related uncertainties. For the quality strategy, we use backtested figures up to July 2019, when our segregated product was launched, and actual figures thereafter. Again, average performance over the total period was quite attractive. While the global financial crisis caused a period of underperformance, the strategy was unaffected by the volatility of the European debt crisis. While the strategy underperformed simply because it was out of fashion in 2014, it was almost unaffected by the uncertainties of 2015 and 2016. While it initially held up well, the consecutive supply-side shocks from COVID, Ukraine, Eskom and Transnet resulted in multiple quarters when quality companies got neglected. We can make a few interesting observations when looking at relative performance of the three individual strategies on the same chart. During the global financial crisis, all three strategies underperformed. However, while value and quality started to lag in 2008, trending still held up nicely. And when trending also started to lag in 2009, both value and quality experienced strong recoveries. In 2014, when quality was out of fashion, both trending and value held up well. And 2017, when trending went through a bad patch, value and quality came through strongly. When COVID broke out early in 2020, value underperformed, while trending and quality still held up. And then when the tables turned for quality and trending in 2021, value delivered exceptional performance. It is clear that there will be material diversification benefits if these strategies are to be combined in one product. Our Momentum Core Equity Fund does just that. While investors in this fund would participate in the pleasing returns that the focused underlying trending, value and quality building blocks are likely to deliver, they would also enjoy a much smoother ride as different styles are often out of sync. And the inclusion of a tracker component introduces an additional level of risk reduction. This chart shows how a fund that is invested in an equal weighted blend of trending value, quality and tracker components would have performed. While this strategy on average performed well over the observation period, the cyclical behavior that was present when single styles were discussed is still at play, but at a materially reduced level. While single factor funds could have lagged by more than 10% per annum during extreme periods, this strategy would seldom have lagged its benchmark by more than 5%. The underperformance during the global financial crisis would have been both muted and short-lived. While individual styles all experienced material pain during the consecutive supply-side shocks that started with COVID early in 2020, the diversified strategy held up well from early 2020 until late in 2022. While it did experience a few quarters of underperformance thereafter, it did not dip below the 5% level despite extreme market conditions. And just like the single factor funds, the blended strategy also typically experienced periods of strong outperformance after pullbacks. The Momentum Core Equity Fund outperformed its benchmark by 12% since inception in April 2017. It achieved this despite tough markets over most of its lifetime and without exposing investors to ridiculous drawdowns relative to its benchmark. In a nutshell, while smart beta factors tend to perform well over a cycle, some lagging within cycles is normal. Periods of underperformance often happen during uncertain times. However, the future intensity, start and end dates of these volatile periods are unknown. And sometimes periods of extreme stress, like that was experienced during the European debt crisis, turn out to be non-events. The elections will soon be behind us, and markets often fare much better once a feared event is in the past than when it is in the future. The answer is to diversify over multiple factors to enjoy a smoother ride. Thank you for your attention.
Thanks, Lofty. Really informative stuff. Mike Atsatz will now summarize and close the webinar. Thank you for joining us today. You have the floor, Mike.
Thank you, Michael. And thank you, audience, for attending the latest edition of our Investment Gurus, where we explored the theme of investment management under conditions of political and economic uncertainty, which is definitely the scenario we face so close to the next general elections. We started our session with Sanisha that unpacked the political environment and the likely role of coalitions and the format of coalitions, which will be a big feature post the next general election, and that is going to have a significant impact around policy formation and the trajectory for the South African political environment and economy going forward. Next, I moderated an investment panel where we chatted to Herman, Keegan and Pello just about managing portfolios in times of political and economic uncertainty, with not just the local scenario of elections in South Africa, but also the global geopolitical backdrop. And one of the important themes that came through there is you never have a crystal ball. You never know what the future is going to hold. You need to manage portfolios sensibly, and diversification, once again, is your friend. That was followed by Ian, who spoke about the difficulty and opportunities of managing fixed interest portfolios in times of political uncertainty coming up to the election. So we've seen good returns in the cash markets, but a very difficult environment for the bond markets, and how you could be in a scenario where there's quite divergent outcomes in the short-term returns of fixed interest portfolios based on the configuration of coalitions and policy formation going forward. That was finished off with Lofty, who spoke a little about the impact of factors under political and economic uncertainty. And what Lofty reminded us of is that investing is a long-term gain. There's always going to be risks, and associated with risks there'll be opportunities as well. So sometimes you do need to pull yourself away from the short-term environment and think longer term, because there will be good investment opportunities across portfolios and investment asset classes. So thank you once again for attending the latest edition of our Investment Gurus. With the upcoming election, your voice and your vote matters. So please go out and spend those long hours in the queue. And I thank you for your attendance.